There are moments in financial history when the standard advice stops working, moments when the old playbook becomes dangerous, moments when what everyone assumes is safe becomes the biggest risk of all. I believe we are in one of those moments right now. I have spent over 40 years in banking. I have navigated every major financial crisis since the 1980s. I was there during the savings and loan crisis. I was there during the dot-com crash. I was in the room during the 2008 financial crisis, when we came within hours of a complete collapse of the global financial system. I have watched fortunes made and lost. I have seen families destroyed by decisions that seemed smart at the time, but turned out to be catastrophic. And I have learned to recognize the signs that precede major shifts in the financial landscape. Let me tell you about a conversation I had during the 2008 crisis that has stayed with me ever since. I was speaking with a man who had done everything right by conventional standards. He had a good job. He had saved consistently. He had invested in a diversified portfolio. He was approaching retirement with what he thought was enough to live comfortably for the rest of his life. Then the crisis hit. His portfolio dropped by 50%. His home value collapsed. His company started layoffs, and he was suddenly worried about whether he would keep his job. He called me in a state of panic. He did not know what to do. He was facing the possibility that everything he had worked for over 40 years could be destroyed in a matter of months. The tragedy is that his situation was largely avoidable. Not the market crash that was beyond anyone's control, but his vulnerability to it. With different preparation, different positioning, he could have weathered the crisis with minimal disruption to his life. Instead, he was devastated. I think about that conversation often, especially now, because what I am seeing right now concerns me deeply, not because I am predicting an imminent crash. I am not a market timer, and I do not make predictions about what will happen next week or next month. What concerns me is the combination of factors building in the economy that create elevated risk for anyone who is not prepared. We have government debt at levels never seen before in peacetime. We have interest rates that have risen faster than at any time in decades. We have a commercial real estate market showing serious stress. We have geopolitical tensions that could disrupt global trade and supply chains. We have an artificial intelligence revolution that will transform industries in ways we are only beginning to understand. Any one of these factors would warrant attention together. They create an environment where the financial moves you make in the next few months could determine your financial security for the next decade. That is why I want to share with you the 3 financial moves I believe everyone should make right now. These are not speculative bets. These are not get-rich-quick schemes. These are fundamental defensive adjustments that will protect you if things go wrong, while still allowing you to prosper if things go right. Let me be clear about something before I continue. I am not telling you to panic. I am not telling you to sell everything and hide in a bunker. I am telling you to prepare. There is a profound difference between panic and preparation. Panic destroys wealth. Preparation protects it. The first financial move everyone should make right now is to build a substantial cash reserve. I mean substantially more cash than you currently have. More than the standard advice suggests, more than feels comfortable. The conventional wisdom says you should have 3 to 6 months of expenses in an emergency fund. That advice was developed for normal times. We are not in normal times. The economic environment we face has more uncertainty, more potential for disruption, more ways that things could go wrong than at any point in my career. I would recommend having at least 12 months of living expenses in cash and cash equivalents. For some people, 18 months or even 20. For months might be appropriate depending on their situation. If you are over 60, if you work in a volatile industry, if you have health issues, if your skills are specialized and not easily transferred, you need more cash. Let me explain why this matters so much right now. First, job security is more precarious than it appears. The unemployment rate is low, but that can change quickly. Technology is eliminating jobs faster than new ones are being created. Artificial intelligence is going to accelerate this trend dramatically. Companies are restructuring. Entire industries are being disrupted. The job you have today might not exist in 2 years. The company you work for might not exist in 5 years. I have watched this happen repeatedly throughout my career. People who thought they were secure suddenly find themselves unemployed. It happens to executives who thought they were indispensable. It happens to middle managers who thought they were safe. It happens to workers at every level who thought their skills would always be in demand. And when it happens, having cash is the difference between a temporary setback and a financial catastrophe. The people who had cash reserves when they lost their jobs could take time to find the right next opportunity. They could retrain, they could start businesses, they could make thoughtful decisions. The people who did not have cash reserves were forced to take the first job offered, often at lower pay. They depleted retirement accounts, they went into debt, they made desperate decisions that compounded their problems. Second, the financial system itself could face stress. I do not expect a repeat of 2008, but I cannot rule it out either. Regional banks are under pressure from commercial real estate losses. Some of them will fail. We have already seen this with Silicon Valley Bank and First Republic. More failures are coming. When banks fail, even insured depositors can face temporary loss of access to their funds. Having cash spread across multiple institutions provides protection. I remember during 2008 when people could not access their money for days or weeks while institutions sorted out failures and mergers. ATMs ran out of cash, transactions did not process. People who had everything at one institution were helpless. People who had diversified across institutions maintained access to at least some of their funds. Third, opportunities will emerge. Every period of stress creates opportunities for those who have capital to deploy. The best investments I have ever seen were made during times of crisis by people who had cash when others did not. If you are fully invested with no cash reserves, you cannot take advantage of these opportunities. You might even be forced to sell at the worst possible time to meet obligations. During the 2008 crisis, I saw people with cash buy homes at half their previous value. I saw them buy stocks at generational lows. I saw them acquire businesses at distressed prices. These opportunities existed precisely because most people did not have cash. They were selling, the people with cash were buying. That is when fortunes are made. Fourth, cash provides psychological stability. When you have a substantial cash reserve, you can think clearly during times of stress. You are not worried about making rent or paying for groceries. You can make decisions based on long-term value rather than short-term desperation. That clarity of thinking is worth more than any investment return. No, where should you hold this cash? I would spread it across several options. Keep some in your primary bank checking account for immediate access. Keep some in a high-yield savings account at an online bank where you can earn 4 or 5%. Keep some in short-term treasury bills, which you can buy directly from the government at treasurydirect.gov. Keep a small amount, perhaps a few $1,000s, in physical cash at home in a secure location. This diversification of cash holdings protects you against multiple scenarios. If your bank has problems, you have accounts elsewhere. If the banking system has problems, you have treasury bills held directly with the government. If electronic systems have problems, you have physical cash. Some people will say this is excessive. They will say holding so much cash means missing out on investment returns. They are right that cash has an opportunity cost. But that cost is the premium you pay for security and optionality. It is insurance. And right now, that insurance is worth paying for. The second financial move everyone should make right now is to reduce your exposure to risky assets, particularly assets that depend on continued low interest rates and easy credit conditions. For most of my career, we lived in a world of declining interest rates. From the early 1980s, when rates peaked at over 15%, rates fell almost continuously for 40 years. That falling rate environment was enormously favorable for asset prices. Stocks rose, bonds rose, real estate rose. Almost everything rose because falling rates make future cash flows more valuable. People who started investing in the 1980s or 90s have never known anything but this environment. They think it is normal. They think it will continue. They have built their investment strategies around assumptions that may no longer hold. That era is over. Rates are no longer at zero. The Federal Reserve has signaled that rates will remain higher for longer. The government's borrowing needs will keep upward pressure on long-term rates. We are in a different world now, and portfolios need to be adjusted accordingly. Let me explain why this shift matters so much. When interest rates were near zero, investors were forced into riskier assets to generate any return at all. They bought stocks at high valuations. They bought bonds with long maturities. They bought real estate at premium prices. They bought speculative assets that paid nothing because everything else paid nothing either. Now that rates are higher, those assets face competition. You can earn 5% in a treasury bill with no risk. Why would you accept the risk of stocks unless they offer substantially higher expected returns? Why would you lock up your money in real estate unless the yield is significantly better than risk? Free alternatives. The math of investing has fundamentally changed. What does this mean practically first? Be cautious about long-duration bonds. When interest rates rise, long-term bond prices fall. We saw this dramatically in 2022 when long-term treasury bonds lost more than 30% of their value. That was the worst year for bonds in American history. If rates rise further, those losses will continue. I would reduce exposure to bonds with maturities longer than 5 years and focus on shorter-term securities. The mathematics of bond duration are unforgiving. A 30-year treasury bond can lose 20% of its value from a 1% increase in rates. That is not a conservative investment. That is a leverage bet on interest rates declining. Do not make that bet unless you are very confident about the direction of rates. Second, be cautious about highly leveraged companies. Companies that borrowed heavily when rates were low are now facing much higher refinancing costs. Some of them will not survive. Look at the debt levels of any company you own. If a company has more debt than it can comfortably service at current interest rates, consider reducing your position. I have watched this cycle play out repeatedly. Companies borrow heavily during good times when credit is cheap and available. Then conditions change, their debt becomes a crushing burden. They cannot refinance, they cannot grow. Eventually, they fail or are forced into distressed sales. The equity holders lose everything. Third, be cautious about commercial real estate, either direct ownership or through REITs. Office buildings are facing structural decline from remote work. Vacancy rates are at record highs in many cities. Retail continues to be challenged by e-commerce. Even multifamily is seeing stress in some markets from oversupply. The commercial real estate sector has significant problems that have not yet fully materialized in prices. I have been warning about commercial real estate for several years now. The problems are obvious to anyone who looks, but prices have not yet fully adjusted because transactions are frozen. Owners do not want to sell at distressed prices. Lenders do not want to foreclose because then they have to recognize losses. So everyone pretends the problem does not exist. But it does exist, and eventually reality will assert itself. Fourth, be cautious about speculative investments with no cash flow, cryptocurrencies, unprofitable technology companies, meme stocks, speculative options positions. These performed extraordinarily well when money was free and speculation was rewarded. They perform terribly when money has a cost and fundamentals matter. If you own these assets, consider whether you are comfortable with potentially losing most or all of your position. I do not understand the appeal of assets that produce nothing. They are pure speculation on finding someone willing to pay more later. Sometimes that works. Often it does not. The people who made money on these speculative assets were mostly early. The people who bought later were mostly left holding the losses. Fifth, be cautious about concentration in any single asset. I see too many people with most of their net worth in their employer's stock or in their home or in a single investment that has done well. Concentration creates enormous risk. If that single asset declines significantly, your entire financial position is compromised. Diversify now. I want to be clear that I am not saying sell everything and go to cash. That would be timing the market, which does not work. What I am saying is to examine your portfolio with fresh eyes. Ask yourself honestly, if we entered a serious recession tomorrow, how would my portfolio perform? If interest rates rose another 2%, what would happen to my holdings? If credit conditions tightened significantly, which of my investments would be most vulnerable? The goal is not to eliminate all risk. Risk is inherent in investing. The goal is to ensure that no single risk can devastate your financial position. The goal is resilience, the ability to survive multiple adverse scenarios without catastrophic loss. Let me tell you what I would emphasize instead of the risky assets I mentioned. I would emphasize high-quality dividend-paying stocks of companies with strong balance sheets and essential products. Companies like Procter & Gamble, Johnson & Johnson, Coca-Cola. These companies have survived every recession, every crisis. Every market crash, they maintain their dividends, they provide stable income. They might not make you rich quickly, but they will not make you poor either. I would emphasize short to intermediate term treasury securities. These provide safety, liquidity, and currently attractive yields. You can earn 4 to 5% with essentially no credit risk. That is a reasonable return for the safety you receive. I would emphasize tangible assets that hold value regardless of financial market conditions. Your home, if owned without excessive mortgage debt, your skills and earning capacity, your relationships and network, these assets cannot be marked down by market fluctuations. The third financial move everyone should make right now is to eliminate or substantially reduce your debt, particularly variable rate debt and debt used for consumption rather than investment. Debt is a magnifier. It magnifies gains when things go well and magnifies losses when things go badly. In an environment of elevated uncertainty, you want to reduce magnification. You want to reduce the ways that external events can damage your financial position. And debt is the primary way that external events cause financial damage to households. I have spent my entire career in banking. I understand debt intimately from the lender's perspective. And I can tell you that debt is a double-edged sword that cuts the borrower more often than it helps them. The interest you pay is a guaranteed cost. The benefit you hope to receive from borrowed money is speculative. In the long run, the guaranteed costs usually exceed the speculative benefits. This is especially true in the current environment. Interest rates have increased dramatically. Debt that seemed manageable at 3% interest becomes crushing at 8%. Variable rate debt that seemed affordable when rates were at 0 becomes dangerous. When rates are at 5%, the cost of carrying debt has roughly doubled or tripled compared to just a few years ago. Let me explain the different types of debt and how I would think about each. Credit card debt is the most dangerous and should be eliminated first. Credit cards charge interest rates of 20% or more. No investment reliably returns 20%. Every dollar you carry on a credit card is costing you enormously. If you have credit card debt, paying it off is the highest return. Lowest risk financial move available to you. Nothing else comes close. I am continually amazed by people who carry credit card balances while also holding investment portfolios. They are paying 20% interest while earning perhaps 8% on their investments. The math makes no sense. They are guaranteed to lose money on that spread. Pay off the credit card. Then invest. If you cannot pay off your credit card balance immediately, at least stop using the cards for new purchases. Pay cash for everything until the balance is zero. Look for ways to reduce the interest rate, either through balance transfer offers or personal loans at lower rates. Make paying off credit cards your top financial priority. Auto loans are the next priority, particularly if they have high interest rates. Many people took out auto loans at low rates during the pandemic era. If that is your situation, the loan may be manageable. But if you have a newer auto loan at 7 or 8% interest, consider whether you could pay it down faster. And when the loan is paid off, do not immediately take out a new loan for a more expensive car drive. I see too many people trapped in a cycle of car payments. They pay off one car and immediately finance another, often more expensive one. They never experience the freedom of owning a car outright. They never have those monthly payments available for saving and investing. Break that cycle. Drive your car until it is paid off. Then keep driving it while you save the payment amount. Personal loans and lines of credit should be paid off and the lines closed. Having available credit is not an asset. It is a temptation and a potential liability. The credit limits count against your overall credit profile and can make it harder to obtain credit when you actually need it. Pay these off and simplify your financial life. Mortgages are more complicated because they are usually lower rate and often tax deductible. If you have a low rate mortgage from the pandemic era at 3% or less, there is no urgency to pay it off early. That debt is cheap, but if you have a newer mortgage at 7% or if you have a variable rate mortgage, consider whether you can refinance or pay down principal faster. For older Americans approaching retirement, I would strongly consider paying off the mortgage entirely if possible. The psychological benefit of owning your home free and clear is enormous. No matter what happens in the economy, you have a place to live. That security is worth a lot. Home equity lines of credit are particularly concerning right now. Many of these have variable rates that have increased significantly. Some people took out large HELOCs when rates were low and are now facing payments they did not anticipate. If you have a HELOC with a significant balance, prioritize paying it down. Student loans are complex and depend heavily on individual circumstances. If you have federal loans with income-driven repayment options, those may be manageable. If you have private loans at high rates, they should be prioritized for payoff. The key is to not let student debt prevent you from making other essential financial moves, like building cash reserves. Here is the framework I would use for debt payoff. List all your debts. For each debt, note the balance, the interest rate, and whether the rate is fixed or variable. Prioritize paying off the highest rate debts first, especially if they are variable rate. Make minimum payments on lower rate debts while aggressively paying down high rate debts. Once a debt is paid off, redirect those payments to the next debt on your list. This process can take years, and that is fine. The goal is progress in the right direction, not perfection overnight. Every dollar of debt you eliminate is a dollar that cannot be used against you in a crisis. Every payment you eliminate is one less obligation you must meet, regardless of what happens to your income. Lenny D also says something about not taking on new debt. In an uncertain environment, the worst thing you can do is increase your obligations. Do not buy a bigger house than you need. Do not buy a more expensive car than necessary. Do not finance purchases that you could pay for in cash or simply do without. I see too many people whose financial stress is entirely self-created. They earn good incomes, but are broke because they have committed themselves to payments on houses, cars, boats, vacations, and consumer goods. They have no margin for error. Any disruption to their income immediately becomes a crisis. Do not be one of those people. Build margin into your life. Spend less than you earn. Avoid new debt. Pay off existing debt. These are simple principles, but following them puts you in a fundamentally stronger position than people with higher incomes who have not followed them. Now let me bring all three of these moves together and explain how they work as a system building. Cash reserves provides immediate security and optionality. You have resources to handle emergencies. You have capital to deploy when opportunities arise. You can make decisions from a position of strength rather than desperation. Reducing exposure to risky assets protects your portfolio from scenarios that could cause severe losses. You maintain exposure to quality assets that will recover after any downturn. You avoid the concentrated bets that destroy wealth when they go wrong. Eliminating debt reduces your fixed obligations and increases your flexibility. You need less income to maintain your lifestyle. You have more capacity to save and invest. You are less vulnerable to interest rate increases or income disruptions. Together, these three moves create a financial position that can withstand almost anything. Not a position optimized for maximum returns in the best case, but a position that survives and prospers across a wide range of scenarios. This is how I think about personal finance, and it is how I have thought about risk management throughout my career. The goal is not to predict the future perfectly. The goal is to be positioned so that you do well regardless of what future unfolds. The goal is resilience. Let me address some objections I anticipate to this advice. Some people will say I am being too conservative. They will say that by building large cash reserves and reducing risk, you sacrifice returns that could compound into significant wealth over time. They are correct that this approach will likely lag aggressive strategies during bull markets, but those aggressive strategies also crash during bear markets. They also cause financial ruin when things go wrong. The question is not which approach performs better in the best case. The question is which approach you can actually execute through the full range of market conditions without making devastating mistakes. Some people will say that paying off low-rate debt while holding cash earning similar rates does not make mathematical sense. They are correct about the math in isolation, but they are ignoring the psychological and practical benefits of being debt-free. They are ignoring the reduction in fixed obligations. They are ignoring the flexibility that comes from not owing anyone anything. The math is close enough that the other benefits tip the scale toward debt payoff. Some people will say that building a large cash position is impossible given their income and expenses. For some people, this is genuinely true, but for most people, it is a matter of priorities. They could build cash reserves if they cut discretionary spending, downsized their housing, sold a vehicle, or made other lifestyle adjustments. The question is whether financial security is important enough to make those adjustments. I would argue it should be. Some people will say that my concerns are overblown, that the economy is fine, that markets will continue rising. They might be right. I hope they are right. But hope is not a strategy. The time to prepare for storms is when the sun is shining. The time to build financial strength is before you need it. If my concerns prove overblown and everything goes well, you will have sacrificed some returns but remained in a strong position. If my concerns prove justified and things go badly, you will have protected yourself and your family from harm. That asymmetry favors preparation. Let me close with some thoughts on the broader context of these recommendations. We are living through a period of profound change. The economic structures that define the past 40 years, falling interest rates, globalization, relative geopolitical stability, are all being challenged. The world my children will navigate will be different from the world I navigated. The financial strategies that worked in the past may not work in the future. In this environment, the most valuable assets are the ones that cannot be taken from you. Your skills, your relationships, your health, your ability to adapt and learn, your financial resilience built through the moves I have described. Material wealth matters, but it matters less than most people think. I have known wealthy people who were miserable and financially precarious because they lived beyond their means and had no margin for error. I have known people of modest means who were secure and content because they lived within their means and had prepared for adversity. The three financial moves I have described, building cash reserves, reducing risky exposures, and eliminating debt, are ultimately about creating freedom. Freedom from financial stress, freedom from dependence on favorable conditions, freedom to make choices based on what matters to you rather than what you are forced to do. That freedom is worth more than any investment return. It is worth more than any material possession. It is the foundation of a good life, and it is available to anyone willing to make the choices necessary to achieve it. Make these moves now while you can, while conditions allow, while there is no urgency forcing your hand. Your future self will thank you, your family will thank you, and whatever comes next in the economy or the markets, you will be ready. I have seen too many people wait until crisis arrives to prepare for crisis. By then it is too late. The time to build the ark is before the flood, not during it. The time to build financial strength is now today, this week. Do not wait for perfect conditions. Do not wait until you feel comfortable. Do not wait until the economic clouds look more threatening. By the time everyone sees the danger, the opportunity to prepare has passed. These are the three financial moves everyone should make right now. Build your cash reserves to at least 12 months of expenses. Reduce your exposure to risky assets that depend on low rates and easy credit. Eliminate or substantially reduce your debt, starting with the highest rate obligations. Simple advice. Hard to follow. But the people who follow it will be the ones who thrive, regardless of what happens next. I have seen this pattern repeat throughout my entire career in banking and finance. I am as confident in it as I am in anything in finance. Let me leave you with one final thought. The purpose of money is not to accumulate the largest possible pile. The purpose of money is to provide security, freedom, and options. A person with modest savings and no debt is wealthier in every meaningful sense than a person with a large portfolio but crushing obligations. The person with savings and no debt sleeps well. They can make choices. They can say no to things they do not want to do. They are free. That freedom is what these three financial moves ultimately provide. They do not guarantee wealth. They do not promise extraordinary returns. They provide something more valuable, the ability to withstand adversity and emerge intact on the other side. I have watched countless people destroy themselves financially by chasing returns while ignoring resilience. They were optimizing for the best case while leaving themselves vulnerable to the worst case. When the worst case arrived, as it eventually does for everyone, they were destroyed. Do not be one of those people. Build resilience first. Build cash reserves. Reduce unnecessary risk. Eliminate debt. Then, from that foundation of strength, pursue growth opportunities. The returns might be slightly lower than aggressive approaches during good times, but the returns will be infinitely higher during bad times, because you will still have returns instead of catastrophic losses. The choice is yours. But I hope you choose wisely. The stakes are too high and the time for preparation too short to make any other choice. Start today, start now, take action. Your financial future depends on the decisions you make in the next few months. Make them count.